Oh,
Why would a bank shut down a HELOC? Right? Because I've had many people come to me with a similar type ask or question or response, and I go back to position because position matters. Right now, let's say you've got a mortgage and you're looking to take advantage of that equity, and you get a HELOC. What's in first position? What's in first position is that mortgage. And if the bank is assessing your, I'll call it credit worthiness and your function with this HELOC throughout the time of you having it. If it looks like the balance is being, you're running higher balances than normal and you're not adequately using that HELOC, they will call it due. They will shut it off. They will shut it down. Why? Because they are more concerned about the mortgage. What's in first position is that mortgage. What is most concerning to that bank is making sure that mortgage is paid off. Anything you got secondary to that doesn't really matter to them. So they absolutely will call it due. But let's flip this a little bit. Now, in place of that mortgage is that first position home equity line of credit. What's most important to the bank? What's most important to that bank is that first position home equity line of credit. Why? Because they know if they don't get that, if you're not paying that bill, they don't make money. So they need you. They need to make sure this environment is conducive to make sure that you can do everything you can to make sure you handle that first position product. The first position product takes priority. The first position product is the most important. So if you have a first position HELOC in place of your mortgage, the likelihood of a bank shutting it down is very, very low. I can't provide guarantees. I can't tell you that it will not happen. I can show you the data that says it's highly unlikely, but I can't give you the guarantee that says it won't happen. Why? Because the first position HELOC is the number one item for the bank. Most people who have HELOCs shut down or called due, or the draw period reduced, or the balance reduced, or the HELOC converted to a loan. I've seen that happen as well. I have yet to see that occur in first position. All of those stories that I have seen, that I have been privy to, that I have kind of talked through with clients have been HELOCs in the second position. So who you work with matters. The credit union or the bank that you work with matter. But I think you bring up a very, very good point. And I think that is a consistent thing that I'm hearing, that, hey, HELOCs are bad because banks will call them due or banks will shut them down. I have yet to see that in first position. I think what is being referenced there is the second position version. Why? Because what's most important to the bank is that mortgage, because that's how they make their bread and butter. That's how they make their money. Hopefully that makes sense.